सर जी यहाँ तक कर दीजिएगा, यहाँ चलाना है ना, ये जो पोजीशन है ना, मैं इस पे ज़्यादा रहूँगा। Good morning. We have been discussing international finance. Initially, we talked about the basic concept of international finance, followed by we discussed a lot about the forex market, various aspects of forex market, quotations, how the price quotations of the currencies are made, what is direct, indirect, followed by cross currency and synthetic currency, leading to arbitrage opportunity, followed by we discussed about that how anyone can take arbitrage using even money market. Then we went for forecasting of rates. From forecasting of rates, we had concentrated on forward contract also, how forward contract could be an unbiased predictor of the future dated spot rate. Then we discussed about exposure. Prior to that exposure, we discussed about parity theorems, interest rate parity, purchasing power parity, how price into two different economy for a particular currency will be decided. And even it was one of the way to forecast the exchange rate. If everything had to be constant, everything has to be same. For purchasing power parity, we had used the goods market, and gold parity we had considered. Gold parity means how the price of gold in two different economy will remain equal in real term, and that will determine the exchange rate. Interest rate parity talked about how real interest rate will remain same in two different economy. Then after that we discussed about exposure, possibility of risk, and three different exposures we talked. First exposure was economic exposure, translation exposure, transaction exposure. All three exposures we talked. Economic exposure was there when an organization is looking to establish business in other country. Whatever the kind of risk is expected, that is country risk and currency risk in addition to business risk. When we say currency risk, it is the exchange rate which is important. When we say country risk, it means political risk, social risk related to bilateral relationship. That is also very important. Once company has been established there, then headquarter is lying in one country, subsidiaries are lying in other countries. So when parent company want to make a consolidated annual report, so merging the two income statement and balance sheet is required, and that merging two income statement and balance sheets belonging to two different currency denomination notation, a translation is required, where we studied four different methods of translation. It was current, non-current method was there, monetary, non-monetary method was there, temporal method was there, current rate method was there. FASB 52 that we had followed. And how ultimately the treatment related to forex gain and loss because of any kind of a exchange difference coming up at two different point of time or two different item treatment like in balance sheet, that also we discussed. And these all are various aspects we have already covered up. When we talked about transaction exposure, it was more related to someone who is exporting, importing, or lending or receiving, borrowing. Then the kind of exposure which is there, that is called transaction exposure. Entire financial derivative is actually meant for hedging the transaction exposure. So an exporter is there who has got exposure of depreciating foreign currency, or an importer has got a problem with appreciating foreign currency, then in that case that has to be taken care of, and this is we have already covered up. Now we are going to start with a new chapter, a rather complete new block of the discussion, and that is called working capital management and specific to cash management of a multinational company. Cash management is always important for any organization. Cash is liquid. Availability of liquidity with the organization not only makes them run the business comfortably, even it decides the profitability also. Available money in time is a big gain, but excess money lying idle with the organization is loss of opportunity to earn out of that money. This applies to everyone. How much cash ought to be there, that has to be specified. How much you keep with you, that has to be taken care of. So this is what really needed. It has to be understood. Now, one important aspect which we have to understand here is, if one organization has to be careful with this, if a multi-location, multinational organization is there, who is operating in number of countries, having exposure in different currencies, how they will decide how they are going to manage. Now, locally, if you talk about for a country-specific organization, we had different thumb rules. We have to make a cash flow statement, look for a projection of the cash need, and accordingly decide whether we have a cash availability or not, and do as per the requirement. If you feel you have a cash crunch, look into that, from which sources you will generate the cash, or you will defer some of the expenditure so that cash requirement which is appearing, which is emerging, should be deferred to some future period. Whereas if surplus is there, where you will park that surplus, for how long you will park that surplus. These are the questions which is there. But here, if it is for a number of locations, so many countries you are operating, it might be possible at one place you are surplus, another place you are just, third place you are in crunch. Because suppose someone is a cash crunch, borrowing cash from financial institution is a cost. So it is important that how you are going to plan, how you are making actual payment. Like two things are there. First, suppose a company located in India has to make payment to Australian unit, and have to receive payment also from Australian unit, right? Both are there in the same way. Of course, here we will assume that whenever it is the payment is there, one of the currency is going to be utilized. And normally we will talk about parent currency. Parent currency has to be there. And even if parent currency is not there, because at the time of the cash management, at the time of payment or receipt, it is going to get adjusted, translated as per the spot rate, whatever spot rate is there. Before going to managing multinational, I'll give you a very simple example. Let's even in the local one, where fortunately I had extended my consultancy looking into that, what kind of cash management and organization based at Gurgaon. Long back, I'm talking somewhere in 2003, 4, 20 years back. They were looking for working capital financing, and that also to the tune of 50 lakhs at that point of time. That company was making magazines, computer related magazines, and every magazine used to have that CD also, attached CD in the magazine. So they were making, they were producing. When the uh, request came to me, I started looking into their details. Ultimately, request was there that they wanted to had a cheaper way to manage to borrow 50 lakhs. Cheapest funding should have been possible, and that arrangement has to be made. When I monitored their receivables and payables, an interesting information came to my light. It was there that the company was able to sell their magazines throughout country, where it is in Bhopal, Mumbai, Chandigarh, Patna, and so on, Lucknow, everywhere. They had the node, and they were selling the magazines because it was throughout. Well known, well reputed magazine was there, throughout magazine was available. And whatever they had managed, they had one small offices at every place, most of the prominent city, and everywhere there was a bank account, available bank account. And when I started counting that, somewhere around a dozen of branch I monitored and their bank balances I looked upon, individual bank balances of those branches, when I summed them up, I found that more than 50 lakhs was lying idle in their own current account. See, the headquarters sitting at Gurgaon was looking for funding of 50 lakh rupees. How it could be cheaply available, that was the request they were trying to make me. Whereas they already had more than 50 lakhs in their different accounts. Not knowing, okay, they have this much of account. So finally, because whatever collection used to be there was no discipline in transferring those collections back to the parent company in time. Bankers who are respective bank branches were enjoying those things. These all are the certain aspects which is very, very important. So when I looked upon these things, ultimately it got decided. I said that you don't require to borrow. What you require to look for some financial solutions, a nice arrangement, so-called pool account concept with your banker. First thing you do that, whatever your parent account is there with the bank, same bank you use everywhere. So if you have an account with SBI, use SBI. You have an account with Canara Bank, use Canara Bank. And pool account concept use. And give an standing instruction, whatever the minimum balance is required in your subsidy account, your local accounts, your branch accounts, rest amount should be automatically transferred to the head accounts. So you will find out in one small instruction, your entire cash will come to you. Second, convert your branch into a cost center, not as a profit center. Only all the expenditures should be disbursed from the parent account, not from the local account. These are the certain ways through which one can manage. Similar kind of fund locked in, and the challenges related to fund had been noticed long back. Even prior to that, in 2001-2, when I had an opportunity to look into the account of Indian Archaeological Department, Archaeological Department, and a good number of monuments in India is lying under Archaeological Department, right? And not only monuments, understand that monuments people visit, right or not? People visit, and people visit, there is a ticket counter and there is a cash collection. and cash collection, so how cash rotates there? That's again interesting part. And it is not only archaeological department, so many departments are there. So one side, and mind it, if a ticket is collected, say at your Red Fort, doesn't mean that money will be used to maintain the Red Fort. Maintenance is somewhere else. So entire cash management is now required into a good exercise. Being a government organization, they don't understand the respective component of how best cash management could be there. Not only that, interestingly, a good number of archaeological centers had got foreign currency tax, ticket collections. Now I am talking pre-digital era, where you had to have that cash, give dollar and make, and dollar was not a converted dollar. It was actually a different price in the dollar. Is it clear? It is not something like equivalent is going to be there. Foreign currency rates had been, and you are collecting. And very interestingly, some of the archaeological centers were in a remotest area, where visitors used to go. But interestingly, the manager of that center used to keep the forex reserve with them. I had that also came to me just because of forex to me. So they were keeping it in the 2-lock Almirah inside box, and that without understanding that they might be losing the opportunity to have that forex returns. Okay, that's the way it is. They were very safe. So this is what I am trying to point out, that this is a small pockets I considered, where if you talk about multinationals, how they are going to manage it, and the kind of companies who may be present in more than 100 countries. So understand the gravity of it. Finally, we are going to discuss here, which will help you to enable you in writing the examination. A small numerical will be there. What is important here is that best way to manage cash is keep the cash which will never make any kind of a stress to you related to any payables present. Whatever payables are there, you should be in a position to pay back. So what is really required is, can it be possible you can synchronize your receivables and payables? Synchronization of receivables and payables means your receivables should fall just before payables. The day you have to make payment, exactly before that your receivables are available to you. Because if suppose it is other way around, you will have to borrow or you will default. And default is a big cost, even cost of reputation. Right or not? Default is a cost of reputation. What is important here is that if suppose you have to make payment on 26th of, or let's say today, 10th of the month, you have to make payment. If your receivables come by 9th evening, you are comfortable. But if your receivables come on 11th, you are defaulter. And for one day you have to borrow. It is going to be cost. So what should be your management here is, when we talk about receivables and payables management, that you should be in a position to make sure that every time payables should be after receivables. How you can manage that is your effort. This is your management. Now what are the various techniques? How we are going to make it? So making it possible only through some of the important cash management techniques. First cash management technique which is there, of course, here I am assuming your cash flow statement and everything is known to you. Cash flow statement will let you know that how much you are going to receive when, how much you are going to pay when, how much is the balance available to you. Your statistical details will be available through your cash flow statement, which comes from your account. But now your management starts. And you look into that, what kind of a payment you will make, when you will make payment. So assume the first thing which we are talking about called leading cash management. What is leading cash management? Leading cash management means, if suppose lead means preponement, lag means deferment. If any receivables which is afterward, let's say I have to make payment on 10th and my receivable is going to come on 15th, can I talk to my paying party that, dear, I have to make a payment on 10th, can you make me available this fund? Now, nothing is free here. If one has the right to pay by 15th, why the party will pay you by 10th? 5 days, because even a single day is an opportunity cost. Right? So what you have to do, you have to make some discount, some offer to them. Pay a little lesser amount, instead of 100 rupees, pay 99.9, 99.5, something like that. Now what is that? What the numerical starts here? You have to evaluate that if you are offering a discount to your own party, okay, how much is going to be the cost? And instead of that, if you borrow from financial institution for that period, how much is going to be the cost? Cheapest should be taken. But mind it, if you are preponing from the party who is supposed to pay you and paying you a little early, maybe because of discount, one more cost is taken care of, that those who pay you even in a fraction of discount early, they are not going to be bad debts. So your bad debts, possibility of bad debts, provisioning for bad debt is going to be saved. Right or not? Look into that, entire things will be taken care of. So what you have to do, can it be possible you can invite, pay in a little early? Early payment is called leading. That is called leading. Leading means preponement. Prepone the cash flow. Now what is lagging? Late, delay, postponement instead of preponement. Can we say the party whom I have to pay, which is actually coming on 10th, I can request that, can it be possible you delay the payment? Right or not? Delay it. And when delay will be there, I will be receiving payment on 15th. So can it be possible I pay you on 16th or 15th evening, something like that, we can make it. So it says again 5 days charge. So now you have 3 possibilities. You look into your delay is going to have a cost. Your preponement has a cost. In neither of the two, then borrowing has got a cost. Look into which one is the cheapest option to you and exercise your cheapest option. This is what cash management has to be made. Is it clear? There is another possibility. What is that possibility? Called pooling of accounts, subjects from so many places. I am, say, Indian headquarter. I am an Indian headquarter, have got various operations in different country. I don't have a payment capacity right now. I have to make payment on 10th. My payment will come on 15th, but my, say, Japanese arm has already got account payment available. Their money is available and they have to make payment, say, on 17th. So they have right now amount, their liability come on 17th. I require to pay today. I don't have a payment, but my payment will come on 16th or 15th. So what will happen then in that case? I will make a payment from that available amount. And by the time their payment arrives, my payment has already come and that will be paid to them. So if everything comes through a pool accounts, then in that case, pool account is a very interesting concept, POOL, pool accounts. Entire oil account in India is a pool account, Indian oil accounts. what the government maintains, because variety of items are there, variety of places are there, different components of products are there, different sub accounts. Pool accounts means one account will have so many sub accounts, and ultimately it will be taken care of. Even in financial market, we understand the pool account concept. A broker always has got a pool account, and all the other parties, as those who open the account with broker, is basically a sub account, right? So pool account concept is there. Managing a pool account is easier than managing hundreds of accounts. They are broker. There is a broker. It's basically anyone. Any broker has got account with the stock exchange, and you have account with them. And like you, thousands of accounts are lying there. Okay. You may be feeling you are trading with the market, but actually you are not trading in the market. It's the broker who is trading in the market. You are just sub account holder. Okay. So exactly that's the way it is. Now that kind of possibility is called pool of accounts. Pooling concept, again, cash management could be possible. There is another very important way to do it called netting of accounts. NETTING, netting of accounts. How netting of account takes place? This is a process in which one has to make a payment and another also has to make payment. I may have to pay $100 and the party also have to make $70 payment to me. So I will net pay only $30. That can get created, net out it. So bilateral netting or multilateral netting could be possible. What is bilateral netting? Transaction between two parties. Transaction between two parties means A and B has got transaction. A has to make payment to B, B has to make payment to A. Let's net it out. Don't make payment. It will actually have two things. First, there will be no actual payment. So all cost associated to payment will switched off. There will be no cost because actual payment doesn't take place, exchange doesn't take place, transfer doesn't take place. Now a good number of country doesn't like it. Monetary authority basically look into that, make payment, because every payment there will be a transaction cost. There is a transaction charge, and that charge will be taken by that authority. So authority will never like that. You should just simply adjust with each other. Adjustment should not be there. Am I clear? That is the way it has to be specified. So what is important here is, in the netting, whatever net value is there, that net value you take out, and cost associated to it. Suppose there is a, let's, for easy to calculate, 1% is the transaction cost. So one has to make payment of 100, another has to make payment of 70. So total transaction cost will be applicable on 170. Two-way transaction. 170, 1% is that is 1.7. 1.7 is going to be transaction cost. And instead of that, if you netted out 100 minus 70, how much is the left? Only 30. So how much is going to be the cost? 0.3. So instead of 1.7 transaction cost, it is only 0.3 is going to be transaction cost, not more than that. So you saved a transaction cost like anything. Your transaction cost has been reduced to more than 80%. Right or not? It's possible. Second, no exposure related to any kind of other transaction issues. This is what netting is there. So understand how netting is going to work. And look here. So management of multinational cash balance. Actually in practice, we will discuss about transfer pricing and related issues also after completing this netting component. Blocked funds are there. What do you mean by blocked funds and how it is going to be used? We will discuss. The factors which is actually has to be looked upon is the size of cash balance, how much cash balance is there. Second, which currency denomination you talk about. As a thumb rule, I mentioned that parent company's currencies normally we treat for evaluation. You may have an Indian parent company may have Australian branch in Australian dollar, Singapore branch in Singapore dollar, okay, Dubai branch in dirham, and so on. But ultimately, evaluation has to be done in INR, Indian rupee. Next is where their cash balances are located. That's also very important. Is it everything is there at parent companies? Not necessarily it should be at parent company. Look upon the balance where you find out the currency is going to appreciate more. Suppose you have got 10 branches, then in that case 10 branches will have 10 different currencies. Branches here means 10 different country location. So 10 different currency, and you have to store at one of the place. It is your own house kind of thing. You have to store that. Why not store in that country where the currency of that country is expected to appreciate more? Even just by keeping your fund will go up because that is appreciable. Don't keep in the currency, don't keep in the country where depreciation is there or expected to depreciate. Understand, it is not a small thing. You have to always be dynamically looking into that where your location should be, where on an average it could be there. Like you look into, for simple example, if you have a USD also in your basket and INR is also in the basket, what is the natural way? Normally USD keep on appreciating. So if even forget about interest rate, if you keep only in the form of USD, ultimately as time passes, your INR value will go up. More and more INR will be available to you. So decide accordingly where to locate your cash, right? Then size, optimize the size. Don't keep all the cash in your current account. Park it effectively, making a trade-off between return and risk so that sufficiently it should be taken care of. So the cost of keeping too much, and it's a very interesting part, how to define too much. Whatever normally the effective cash flow statement decides about how much cash ought to be kept, that has to be put on. And what is your opportunity cost? Opportunity cost here indicates you are holding cash and that cash is kept idle, and in the meantime you should earn out of it. It's better to keep it. But here I like to tell you one very important point. That's very easy and simple, can be done by the organization, but not all the places where you have to make sure that what is the objective and why you are keeping the cash, whether it is allowed or not allowed. Like suppose for a project government has got or any private party has got a fund for a project, but it's a government project and funding is also coming from government. Fund has come. Now question is, my project is in a slow progress where my cash flow will not be immediately required. So I have my idle cash lying in my account and that account is current account. Can I, time being, invest that account for some additional earning? Theoretically sounds good, practically feasible, but legally not allowed. This has happened, a case of in Delhi only one project, private party had put the money into stock market to earn better out of it. They earned also. It's not like that they didn't earn, they earned also, but it was not meant for it. And simply it was said in your objective of the project, never ever investment in the stock exchange has been objective. It was basically the, airport metro expressway is there. That project had been, it was related to Reliance, who were the maker of that. You must have seen crossing Dhaula Kuan and all others, which goes New Delhi to airport. And that track had got time, some money, lying idle, and Reliance, that also younger brother. So finally transferred that money to some deposit. Fairly safe. I am not siphoning money. Money is very much into account. And money is idle. Current account doesn't give you even a single penny. Right? So what you did, you invested it to earn during that period. Clear? Theoretically, nothing wrong, because I am not taking money. It is visible. If I had got 1,000 crore, it will convert into 1,100 crore in the due course, say 10% return. And by that time, money is lying idle, and I'll make payment 100 crore has been added to the project component. But still it was not allowed, because objective doesn't say. It is called diversion of money. Okay? Not allowed to have it. So these are the certain dimensions also we have to look upon. But what we are talking right now in multinational environment, it is not so, unless specifically country comes and says that no, you are not allowed to do that. Or suppose I put money, say in USA, and after that US government says that, sorry dear, you can't take money from here for any other country's payment. Now you are locked. This is what we were talking about, blocked fund. We'll consider those amounts also, those considerations. You want to whatever, it is your money, no denial. It is your account, no denial. You can expend total amount, no problem, but you can't take it out of country. It is called withholding, blocking. Withholding is there. And how to release withholding amount we'll discuss. Okay, sometimes people call it withholding tax. A good number of country has got withholding tax. You can use money, but you can't take back to your country. Deduct that. Okay. Yes, they deduct it. But it is not a tax which is taken by the government. It is lying in your account, but you can spend in that country. Actually, the philosophy is that you are working here, earning here. It is coming from earnings, not your payable. And whatever we are talking receivable is earning. Okay, so it is coming from earnings. And then it says that, like for example, suppose India puts a withholding tax. Now India has not put withholding tax to encourage the investment, and that is what we say 100% repatriation. 100% repatriation means whatever your earning is there, if you wish, any point of time you can take your money and you can go back. There is no as such locked in. There is no as such withholding. Withholding is not there. So that what it gives a kind of a confidence to the foreign investors. Anyway, I can take money back any point of time. So let's, invest there. Right? You must get confidence in those shopkeepers who says that guaranteed 100% refund. When 100% refund is there, 99% time you are not going to refund it. Is it clear? You are not going to return the product. But even simple it is return, that 100% refund gives you a confidence. Okay, good number of developed economy actually works on that, 100% refund concept. We used to make mockery in the earlier period that in India, a style was there, it was a true discouragement, once sold will not get returned. What is this nonsense here? Once sold will not get returned. Why not get returned if I am not happy with your product? Okay, it should be returned. It should be, taken back. It is not like that once sold will not be returned. Right? These are the certain business concepts. We are not going to indulge into those discussions, but yes, certainly it makes a sense. So understand the confidence level you are giving to a buyer, where you says that guaranteed, if you are not satisfied, return 100% refund. Another side you say once sold, not return. you are not very sure about the things. This is the confidence level we consider, how it is going to get created. So, here how you are going to have that opportunity cost associated, you have to look into. Not keeping enough cash, if your cash crunch is there, how cash crunch will be counted, how much is going to be a problem to you if you are having no cash or very low cash. Sometimes it happens, even survival of the organization becomes problem. So many organizations has failed in the past just because in the nick of time cash was not available to them. Right? Even aviation sector we talk about, Indian failures, cash crunch was there, cash was not sufficiently available. Okay. Even ILFS, one of the biggest NBFC, failed in India just because of non-receivables. Receivables didn't turn up. Okay, bad debts, huge bad debts. Right? Whatever the money was supposed to come didn't came. Resultant, company got wiped out. Anyway, being government being very sensitive, tried to bail out those organizations, but some of the organizations like aviation didn't get bailed out, and still they are not flying. Two most important example is Kingfisher and Jet. They are not flying. Yeah. Now next is variability in flow, which currency choice, which we have already discussed. So look upon now. Okay, even if you are compelled to borrow, you need money, fund is not coming, where to borrow? If I have an option to borrow India and Japan, I'll prefer to borrow in Japan. I'm located in both the places. I'll ask my Japanese branch to borrow there, make payment, and I'll pay you afterward. Because India's borrowing cost may be even as on date, which is a kind of a lower rate, not less than 9% it will be available, and I'll get it there at 1% or less than 1%. So borrow there. So place of borrowing is also very important. Or should the firm let each affiliate handle it locally, or it should be managing centralized cash management that I mentioned, where the borrowings cost lowest and investment returns. That's the point I have already mentioned you. Multilateral netting. Netting I had already said. A square of the position in between itself. Okay? That is netting. What is bilateral netting I mentioned? I have to make payment of 100 and I have to receive payment of 70, so it is netted out 30. What is multilateral one? I have to receive payment from her and she has to receive payment from him. She can directly say that, see dear, you directly pay to him. Now understand what is the benefit. Again, cost related benefit is going to come. If I have to receive payment from her, it will be one transaction. He will be paying to her another transaction. And if suppose I also have to pay him, is it clear? So look into that and let's equal amount, time being considered equal amount. She has to give me 100, he has to give her 100, I have to give him 100. And if all three transactions takes place, there will be cost on 300. Right or not? 1% means $3 gone, 3 rupees gone. Now, she says to him that you make him direct payment. So whatever I need, I don't require to make payment. So her payment 100 is not going to come to me. His payment to her is not going to come to her. And whatever, now he has to give me 100. I said, dear, no problem, even I had to give you 100, so it's over. Don't make any payment, no transaction. And payment has already been settled. Payment has already been settled without any transaction cost. This is multilateral netting. It can easily be done. So how netting out can take place? That is what we are going to discuss. This is a kind of a diagrammatic presentation of 4 different economy. The US economy is considered to be a parent economy, and Canada, UK, German, all these are the multi-locations where company is present, whose parent company is in USA. Entire currency has been counted into the US dollar, parent company's currency or parent country's currency. Now look into that. If you minutely observe, you will find out that if it is a kind of a wave structure, everyone is attached to everyone else, and two-way attachment is there. So ultimately what is really required, they have to transfer the fund, and you will find out bidirectional arrows are available, right? Now you can net it out. Netting could be possible. Since each step of netting we will make, you will find out how it takes place. So this is the diagram. I think very easily and conveniently you can make that final net out. Like 30-20, it will become 10 from Canada to US. Here 30-40, again 10 will be from UK to Canada. So when 10 has to go to that, 10 has to go to that. So why not 10 go directly to from here? It will remove that exercise. Okay. So this is the way you have to view. Let's how it moves. It has been just first to be considered. The color change has been indicated, but it is not visible to that extent because you look into here, then look here. Okay. And I request you all to have a look on the screen. Effectively, you will find out that how much change is taking place one by one, step by step. And this is what numerical will be there, but not more than 5 marks. Okay. Other component will also be attached to make it full question, right? But it is very obvious question. It is coming to your exam. Very easy question coming to your exam. Look into that. Is it fine? Just keep on looking at the screen. It's changing. Right? Right? Now, right? Okay. Now suddenly you find out that two-side arrow has converted into single-side arrow. Now we will again go back. This is the first step over. Bilaterally got decided. Now multilateral we will make. Look into that. I am showing you where the change has taken place. Okay. Redoing. Look into that. Between two of the countries, payment is over without disturbing receivables and payables. All receivables and payables had got adjusted. Right? So that's the way it is. Similarly, is it visible? Now look into that. This country and that country also payment is over. You don't require to have payment. Kind of a transaction cost and burdens and all those things had been reduced. And understand every figure normally, if suppose in a bigger organization runs in millions. So it will be a very huge amount. Right? This is what final year. Now there is no possibility. So your parent company US will take only 40 plus 15, which is 55, 40 from UK and 15 from Canada. Okay? This is the only receivables are left. Think of this simpler structure compared to what was original structure. This was original structure. The quantum of money which was flowing and the transaction charges, transaction cost, and other related issues can easily be sorted out just by making this small payment. And none has got affected. Whatever receivables, payables are there has already been taken care of. You may have a question, these inter-receivables and payables may be at a different point of time. Don't mind it. Let it to be a different point of time. We can equivalent it using leading or lagging. We had already discussed leading and lagging. We can bring at a one particular point of time. So monetary equivalency has to be maintained. And I hope this point is very clear to you all. This is the way it has been viewed. Okay. So netting. So finally when we say cash management, even whether it was pooling of account, leading of accounts, lagging of accounts, netting of accounts, you have seen that, how it is going to work. Clear? And a multinational always make it. Not only that, how much is too much also we discussed. From where to borrow, how much to borrow has to be taken care of. Where to park your surplus fund, which location, that also we view. And now we will look into a matter of transfer pricing. What is transfer pricing? Though it is more related to international trade rather than international finance. We will not be studying too much on this in transfer pricing, but interplay is also very important. Now, I'll tell you one interesting component, how the work is going to take place here. Suppose this transfer, do you understand transfer pricing? When one of the company sells or transfers some goods or services to some other company, may be related, linked, then what happens? Pricing becomes an issue. There is no bargain. Either two reasons could be there. First is that you are transferring the goods or service which is not available in the market, maybe semi-finished kind of things. Or second, even if it is available but you are selling to that where receiving end also is your own company. So how to pricing negotiation will take place? You can charge any price. Second, you might have a feel, sir, when it is available in the market there is MRP. Practically not. It is a matter of negotiation. And in the service sector it is very common. Yes or not? Service sector, can you say what is the fee of a doctor? Maybe ranging from 50 rupees to 5,000 rupees, just a single visit. Yes or not? In Delhi itself. Can you say fee of a lawyer? You can't say. Right? May have some lawyer in your lane residing, ready to give you service, say in few thousands only. Some may be charging lakhs also. It depends whom you are contacting. So even if it is available in the market, what price you will charge is not very sure. Okay? Do you feel that even goods also, say true value car is there, let's say someone is selling 2020 model of car, will it be all that model of the same, year, same make, same model will have the same price? No. So you must have been, I'm just trying to give you a, wider scope that how for a same product price could differ, how much you can charge. And when you have a price of, pricing for different intention, your pricing is not pricing, rather it is a kind of a, game plan. It could be possible that a different price will appear. For example, I'll discuss one very simple concept. First, withholding tax or blocked fund, and then after that I'll come back to transfer pricing, how it could be used, how to release those funds. That's required. Normally, say a country where, for example, USA, let's say withholding tax is 20%, 20% withholding tax. Now, I'm an Indian who is exporting to USA. My product is continuously getting exported and for last so many years. And whatever earning I am making there, I am repatriating to country, but every $100, $20 is kept in my account. I have to show that I'm keeping there $20 because that is withholding tax. That is blocked amount. Not 100% blocked. 80 is released. 80 I can repatriate back to my own country, but 20 I have to keep in that country only in my accounts. It is lying. Slowly in a span of time, it has been a substantial amount lying there in my own account. It's my money, but I can't take it back to my own country. See, what could be the various way through which normally those money could be released is like, suppose you having a business there and you are frequently a traveler there, instead of booking from Indian accounts, you book your ticket from that account, say US account. Now you can get that money released because whatever your Indian, don't travel in Indian Airways. Or even from there you can book in Indian Airways, from that accounts you can book in, or some American Airways, you book it. Make some advertisement and other expenditure, don't make it from here, make it from there. They want that expenditure should be there, money will get released. Okay? Various ways through which you can get your money released there, or their local purchasing, of course. These are the way even US wants these things to do. You buy it from here, you spend in that economy. So it is you are not a smarter, rather you are smartly trying to make it, and country wants you should do like that. So that their expenditure is, their consumption is going up. Yes or not? Their economy will run. In spending there is running their economy. Their economy will run. Now there is a second aspect which is coming with, is suppose slowly it got deposited and 2020 has become say $200 million. 20% is $200 million in a span of time. Maybe say in 10 years you are in a position to have it. That much money has accumulated to your account in the USA. And I'm not talking about any illegal repatriation or nonsense. I'm talking totally within the legal boundary what you can do with. So now next step is that, can it be possible you can establish a business there? Say a business of $500 million. And in a business of $500 million investment, let's say you have to have 300 million debt and 200 million equity. Is it clear or not? 300 million debt, 200 million equity, and your equity is already lying there. It is your money. So without paying anything, borrow there itself 300 million, and now 500 million business is established. Your entire 200 million is also released. Now it is a new business, new earning will start. And now it is a US business, not your business there. It is a US business, it has started. See how immediately money got released and you became multinational also. There is another way also, which practically possible, I had consulted and I had suggested also to organization. Suppose you have already got certain amount of money, but that is not sufficient for your equity part, you want to put more equity. Okay. One of the company, Alps Glass House from India, Ghaziabad, Sahibabad rather, had to establish business in USA. This is why I am talking all my previous era where I myself has consulted from Sahibabad. They had to invest there. Now I had a simple, options shown to them. You can do one thing, you can export your machine which you want to put a plant there, you are already making here. You export your machine. Are you getting me? Your machine is there. Machine is second hand. Means it is used machine. And when you are exporting it, what will be the price of machine, a fair valuation has to be done. You do your fair valuation, maybe little on inflated side, which is your own machine. There was a triple benefit out of it, 3 benefits. What was the first benefit? Now you decide your price because under whom you are selling, it is your own business which you are going to establish. So no bargain. I say my machine is of this much worth. Of course, I am saying little lower than whatever the new machine price is there. I am getting gain out of it. So machine is transferred, that is at a higher price as per my wish. Point number 1. Point number 2, right now suppose I had $100 million worth of machine here, fair book value of 100 million worth, and I am selling at 200 million. I am selling at 200 million. So 200 million worth value has gone there. 100 million is a kind of a profit from other sources. That is what your accounting is, profit from other sources, 100 million has come. Point number 2, you have sold now at that. Here when you were charging, your depreciation was on 100 million. Now there it is a depreciation is going to be on 200 million. And depreciation is a non-cash expenditure, and most importantly it is a tax shield in that country. So tax benefit in that country you are going to take. And third very interesting part, this 200 million worth of the machine which you have sent, treat it as an equity. It is an equity from your side. Is that clear? So whatever your debt equity ratio had to be created, your equity has already reached. Suppose 200 million is already lying in your withholding, blocked amount. 200 million asset has gone, that is you have paid it, which will be a part of equity. You call it equity funding. Equity funding, so 400 million has already reached to yours. Now you can easily borrow 600 to 800 million and create 1,000 million, a billion business there. Easily you can do it. And even after 2-3 years that machine goes right off that machine, you create a new machine, your purpose has already been solved, whatever you had to create. These all are window dressings. But why window dressing? Suppose I thought these things because I am in a huge loss in India and my income statement is going to be in red. My shareholder will not be happy with this, my income statement. By doing this one trick, temporarily I translated my income statement into green. Profit making organization. Income from other sources, 100 million, one stroke. My loss was say 30 million. Loss from operation is 30 million. Income from other sources 100 million. 70 million is a profit. And how many people see the income statement? They just look for profit. Company is a continued profit making company. Next year will be seen next year. Hey, this year managed. Clear? This is the way through which. So transfer pricing is always a question mark. Even if you make, I'll simply say in the transfer pricing that even if you do something very fair valuation, still it will be considered as it will not be fair in nature, because the relationship is already established. Was it clear? Even if you do a fair evaluation, it will not be treated as fair, because relationship is visible. How can it be possible? It is something like a justice is there who is making judgment, and culprit is his own son or own brother. Even if he will give a fair justice, let's say really his son is not a culprit, he is innocent, and he gives that innocency, it's a father has been there, that's why it has been made. Transfer pricing is always blamed for it. Transfer pricing is always considered that some favor must have been done. Okay, and that's why it becomes very interesting, especially in the international trade. And the last but not least, when it has to be perceived not fair, why to keep fair? People try to take benefit of their own. So look into that, how it is working. The transfer price is the price that for accounting purposes is assigned to goods and services flowing from one division of a firm to another division. Okay. Controversial for domestic firms, as I told you, controversial will always be there with it. It says, consider the example of a firm that has one division that mills lumber and another that makes furniture. The transfer price of the lumber is a political as well as economic and accounting issues. Always it will be there. In multinational also it becomes issues. For MNC, there exists the added complications. What are those? Differences in a tax rate. Okay. Import duties and quotes, that also you can change, take advantage of it. Exchange rate restrictions on the part of the host country. So, generally, why? Another reason for becoming this is a controversial or blamed component transfer pricing is it is felt that most of the time transfer pricing expertise is used to circumvent some of the law. Some law is restrictive in nature. Okay? Some law is restrictive in nature, and you can reverse that some style of that nature basically where you can make it. Now, and it could be extremely visible disturbances. I call it sometime that you have to enter in a no entry area. Enter in a no entry area. You can't take vehicle inside. Okay. Now question is, law doesn't allow you. Board is there, everything is there. What a smart fellow. This example has occurred in my mind by, sometime long back, older movie I was watching, and in that has been done. What driver did? Driver was of course actor of that film. What hero of that film? What he did? He reversed the vehicle, and on back side he entered. Are you getting me? In the keeping vehicle front way entering, so now it is back way, backward entry. So it is visible that it is not something like in a entry mode, it is something exit mode, it has sometime crossed coming back. Okay, clear cut visible, it's a fun, but transfer pricing is full of these kind of cases, and that's why sometime, especially in some of the special courses like chart accountancy or some of those courses, people are advised to expertise this. Either way, both way it is beneficial, to catch hold also or to support as well. It is something like a ethical hacking or unethical hacking. Hacking is hacking. So how you are going to use it, how you are going to apply it, transfer pricing, thick books are available on transfer pricing. Different concepts are available. So exchange rate restrictions are also there. Block funds, I have already mentioned it. Okay. Several methods are also I mentioned. Transfer pricing is one important point. Instead of doing that, transfer the goods, items. Unbundled services, as I mentioned, unbundling services, some of the services booked from there itself. You can do those exercises. Then parallel and back-to-back loan. Yes, this also very important concept. What you can do it, you can look upon that very blocked amount as your collateral. My fund is there. I am putting a collateral and give me a loan. Carrying loan is not a problem. So what happened? It is a very cheaper one. Suppose generally 1% and 2% difference is going to be there. So easily you can borrow. Let's your amount of 100 million is locked. You are keeping 100 million there and you are saying give me 100 million of loan. So your amount is blocked. Now you are not transferring your amount, which is blocked. You are transferring loan back to your own country. So that is what it is. Parallel and back-to-back loans could be possible. So different ways are there through which fund is going to be released. Swaps could be possible. That's a very interesting part, and it is one of the important topic also in your financial derivatives, which I think I'll explain here to some basic extent. What is swaps and how it works, and that's a full chapter is there in derivatives to make it possible. Suppose I don't require to do some business there in USA. As I was mentioning, my fund is blocked there, 200 million is blocked, and I'm not interested to establish any business. But how to release that fund? Can it be possible I can go for financial swaps? What is financial swaps? Someone is interested to have business in USA. Say let's another Indian is interested to have business in USA. When interested business party is there, and that I come to know. Of course, for this banks are available. Banks will let us know the way forward contract I discussed exactly on the same way. Financial swaps and swap banks are there. They are called swap banks. They are available. I came to know that X Limited is interested to go in USA and establish the business. They require fund there. They are interested to borrow there, or they want to carry it. I said, why you want to carry fund there? Whatever the fund you want to carry, give it to me here. Okay. 200 million, you give it to me here. I will transfer you 200 there itself in that country. Okay. Very easy. Yes, this is a kind of not money laundering. It is not money laundering because money laundering is a different word. I know what you want to say. It is called hawala. Okay. It is called hawala on an individual basis. It is not a money laundering. Money laundering is basically converting black money into white money is called money laundering. Okay, how black money to white money get converted into money laundering, and hawala is one thing. In the hawala, how it happens, somebody there want to bring money through different routes altogether. Both money are white, but you are not the actual earner. In a simple illustration, I can say, to make you understand what is hawala, which had happened earlier. It's my own money. I don't have any reason to earn in USA. My earning is not there in the USD. But I have got a huge black money here in the country. Not that Dheeraj Sahu. You have heard? Mr. Dheeraj Sahu is the name? Who has just been deciphered with a huge quantum of money. For last so many days, counting is going to take place of their money, and today it is expected to complete that quantum, and more than 200 crores of cash has been deciphered. MP is there, Congress MP for Jharkhand, Odisha, so many places. 30 machine is counting money for last so many days. And it is expected, being today is a bank holiday, SBI's employee and near branches employee and machine have been put to that place to keep on 2 floors. Machine countings are there only, and truck wise cash has been taken from him. Okay, I said that is a very interesting story. But anyway, nothing to do with that. That is not our topic. Our topic is how to really look upon hawala. Now, this Money, what is black money? Black money is the local social word. Economic word is called unaccounted money. Real word is unaccounted money. It is not black money. Okay, black money is a common man language. Okay, unaccounted money. Second, in that unaccounted money, what is important is neither source of income is indicated nor tax is paid on that. That's the only two conditions. Third, why tax is not paid whereas income tax department is least bothered about your source of income. Income tax is not bothered whether your income is a legal income or illegal income. You pay tax and you be happy. Say someone is in a crime, maybe very heinous crime, like so contract killer. It's a truth throughout globe. Understand, it is not only for country, throughout globe. And let's say he has earned 1 crore rupees in a year, individual income, and files a return, ITR is there with 1 crore income, sources of income, contract killing. No, not other source, contract killing, straightforward, contract killing. May give the statistics how many murders in that year you have done. Okay? Amount has been there, 1 crore, whatever tax calculation will be there, pay tax, your entire amount is white money. Entire amount is white money. Income tax, and your income will not be challenged now. But problem is there. Why one can't do like that? Because now when assessing officer will see the source of income, so came to know it is a kind of a crime. And when it is a crime, this is his responsibility to inform the concerned department like police. Okay, this person is earning from crime. And that compulsion to inform will lead to another investigation. Now police will be active because killing is a heinous crime and it is crime against nation. Understand, very important. It is not like that the family where crime has taken place, family member says, no, I don't have a complaint against any person. No, this is not. It is a crime against nation and it is not waiting for any kind of FIR. Always keep in mind. Even if nothing is known, with unknown name, a registry has to be made. Is it clear? Whereas in the normal civil case, it's not a criminal offense, civil offense. Suppose someone slapped, went to court and or police station, case has been registered, and after that person says that no, I want to withdraw my case. Yes, you can withdraw the case and person will be free. But not in the case of murder or attempt to murder. These are not the possible. So similarly, so in what is black money? Black money is unaccounted income which is neither source is reported nor tax is paid. Why tax is not paid? Just because of one reason. It will come in the light. You don't want to bring into trail. Now what happens? I want to make it white also. Otherwise, it is very clearly visible that your income is more than your expenditure is more than income. How can it be possible? Then this transaction takes place. I came to know you are working in USA, and from there you are my villager, you are my neighbor, and from there you want to transfer say 100,000 USD to your family member, because I came to know from your father that you want to, your money is white money. You want to send it, you want to make a good house here. Parents has resided in a very that way. No, I'll talk to you. I'll do one thing. Don't worry. When you will transfer, this much of amount will come to you. Okay? Now do one thing. You transfer it to me. Say that amount, let's say at rate of 80, because you know exchange rate is downside when you receive, bid ask, you must be knowing with all transfer charges. So they will give you, so 100,000 means 800,000 will come. I'll give you uh, instead of 800,000, 810,000 I'll give you. 10,000 additional amount I'll give you. You get the benefit, and I got white income, my black money, and your money is, it is in your hand, it is only 8 lakhs, 10 lakhs rupees, which is not a big amount. Which is not a big amount. No one will bother that, okay, anyway, इनका तो लड़का बाहर काम करता है तो इतना तो घर बन सकता है. So your money is a white money, that amount of money got converted into white. There could be another way. Suppose she is very fond of winning, buying lottery, and she got lottery. Somebody will be winner, no? And I have to contact only winner. So every time winner will be there. She got it, 1 crore lottery. 1 crore lottery, it's basically after tax, it will come in your account only 56 lakhs. 56 lakhs. I'll give a simple part. Take 65 lakhs, give the lottery to me. Understand? You take money out. For you, being a marginal, being a smaller one, exhausting 65 lakh is not a big amount. Not a big amount. For me, because I have to have, and I own lottery also. Huh? नहीं, इनको जो पैसा मिला है तो now in the light she is not lottery winner, no? She is not lottery winner, and she has got not that big income. She can easily exhaust 65 lakhs. Okay, until unless you reach to that level, you can easily buy some of the basic thing, necessity, and you can go and buy the land in the, make one house. 65 lakhs कहाँ गायब हो जाएगा पता नहीं चलेगा. Right? And for me it is a white money. और lottery के बाद, और मैं, if now I am in a bigger tax bracket, my white money is there, and in the name of 1 crore I can invest 2 crore. I can hide 1 crore में 1 crore तो छिप ही सकता है. That's the way it is done. So these are the way through which that is hawala. Here it is not hawala. Here what is we are talking about? Swaps, exchange. Come back to the main point. Swaps is what? There is an agreement. Bank is there. There is a complete transaction, and which I mentioned in the financial derivatives. We had it in a morning session. I should have today completed financial swaps. Okay. So these financial swaps is basically one is taking it, and here I am taking. When making benefit, how the benefit will be there? This is swaps. Subject to that, both should not be agreeing for the same. When you are taking exchange, two should be agreed to adjust, and at least one of the parties should be, benefited without other party should be losing. Or even if other party is losing and another is benefited, benefit quantum must be bigger than the loss, and the whatever differential benefit will be there distributed in both the parties. So both the party will be ultimately benefiting. And this is what arrangement of financial swap is going to take place. That arrangement is very simply possible. Clear? So that's the way ultimately swapping is going to take place. Okay, some of the other things are also there, like direct negotiation, export creation. Okay. From there you can start creating the values, different ways through which blocked funds could be covered up. So anyway, my entire discussion related to cash management of the subject is that how MNC is going to manage. Here I like to add on some more concept of the other dimensions of working capital management, because 3 dimensions right now I talked on the working capital management. First is the your cash management, and in cash management itself, multinational receivable and payable management I discussed. Leading, lagging, netting is nothing but ultimately it is multinational receivables and payables are there. Not the local one. Inter organization payments are there. That inter organization, and it could be agreeing when you yourself is present other side also. It is your own. If suppose we say Tata is here in India, Tata is there in Japan, Tata is there in Korea, Tata is there in UK, Tata is there in France, then Tata is, so there is no problem into this all entire management. That management takes place. If I consider inventory management of a multinational, again it is very similar in nature. First, when it is a matter of holding, like cash holding, when we say from where to borrow and where to put your surplus fund, in which currency you should put your surplus fund, that we discussed. So borrowing should be there always in a cheaper environment. Clear? Cash borrowing always in a cheaper environment. And deposit should be there where highest interest rate is available among your available environment. Where highest interest rate will be available, deposit there. Holding currency will be there, the currency which has got potential to appreciate a lot. Okay? Like in India is the highest interest rate. So I am interested to deposit in India compared to Japan, compared to USA, compared to UK, compared to Germany. Like that, India is the high interest rate giving. In India also, I can have FCNR, foreign currency non-resident account. I can have FCR if I am a resident here. FCR is foreign currency resident account. So instead of depositing Indian rupee, I am depositing USD because I am taking higher interest rate. Say USD will fetch only 3% or 4% in USA and 6% is fetching in India, so it is a higher interest rate. Plus, instead of keeping in INR, I am keeping in USD. Whenever it will come, it will be in appreciated way. Clear? Interest will also be high and currency appreciation will also be taken. So that benefit I can enjoy. Can it be applied to other inventory also? What is the inventory practically we talk about is only raw material. See, other inventory we don't consider. Other inventory we don't consider because if you say work in progress is always location. So we can't discuss work in progress to shiftings from here to another place. Finished goods also, if you are a smart multinational, you will not be keeping that much finished goods on yourself, which will be actually a matter of your concern, because you normally, whatever you produce, you sell at a fastest pace. After selling, whatever the quantum of money you have to receive anyway has already been discussed and covered in receivable management. So what is really required in the name of inventory management, you have to have the raw material management. Two things. One is procurement of raw material, another is a storage of raw material. Where to keep it? Procurement of raw material, again same philosophy applies. Where you should buy the raw material? Where it is cheaper. Cheapest raw material is available. Right? Cheapest raw material should be available. Second is where you should store it. Of course, some quantum should be stored where your production is taking place. Logistic cost will also be very important. And if suppose logistic cost is indifferent, then in that case you should keep it where keeping, warehousing is cheaper, storage is cheaper. Now here I like to highlight in the multinational aspects, and especially a bigger quantum of inventory when government is keeping it becomes very important. Say not only cost, even other factors, political factors are also very important. And first philosophy out of political factor comes in is never have a single source. Diversify the sources. Even if your single source is sufficiently able to supply you whatever your need is there. But don't depend on only one. Right? Don't depend on only one. Diversify yourself. Because you don't know what will happen in future. Is it clear or not? If you are dependent on only one, and because anything goes wrong between you and your supplying country, they will stop it and you will be in a trouble. Example, India has not got any oil problem, even if Middle East had been burning, lot of unrest and disturbances like ISIS had been there, ISIS. ISIS had been there, but we were very happy. Let Syria to do it. We will take it from USA. We will take it from Russia. Okay, clear? Russia, when Russia-Ukraine problem came, we heavily imported from Russia, availed all the facilities extended by the Russia, opportunistic facility, discount and the other things, and ready to same currency. But look back, same is not applicable in the case of SIM, computer chip. We had a dependency on one economy, one country, and we suffered a lot because of that. Price has also escalated like anything. All chip-enabled product had been very costly compared in last 5 years of time, right? The price of laptop, price of car, price of other gadgets where your chip is available. You look into in 3 years, inflation has been very high in that product. And we are now trying our best, working overtime, country-wise, to catch the race. Okay? Had it been diversified in a true sense. But anyway, easy to say, not easy to really implement, because whenever it is a manufactured, oil was a available resource, natural resource. Chip is not a natural resource. It is a manufactured item. Manufactured item, and that also high-end manufactured item. High-end manufactured item. So what kind of economy will be ready to ship you? That has to cross-check. So anyway, inventory management ultimately talks about sourcing of raw material, storage of raw material. Clear? Storage-wise also appeared. India had got, again in the oil, we have got a huge oil storage. And interestingly, the UAE is keeping their oil storage here. Now ultimately we are going to buy that. But what is most important aspect is we are charging them warehousing. They are keeping some locations away from their disturbed area, so that at least it will be kept. They also know they are not going to take it back, or even they will take it back, it will be refined one, not the crude one. So we have borrowed crude, rather we have offered our storage to them. They are keeping it, and we will be charging them a storage charge. And a storage charge will be payable in terms of quantum of oil itself. So it is only the certain portion of oil we have to make payment, and entire oil will be ours, and we will refine and we will sell it to others. Now what happens? Where inventory location is, we have got huge benefit out of it. Even if tomorrow there is a conflict, like the way Israel conflict we are right now witnessing, even if it is conflict, and let's say there is a border restriction, hardly make any difference. Our oil reserve is in our country, in our land. Until unless our country politically becomes unstable, that we can't use our own resources, then only that will be a disturbance. And fortunately, in near future, we are not viewing that. In near future, continuation of governance and government policy is viewed, because now we are 5 months away from the formation of next government. So we can view that, same government is going to come, which is actually globally a strong government. So decisive government, who has the ability to take decision in time, and a strong decision. And only one objective to take decision is in betterment of nation, future of nation, vested interest of nation. That is a very important aspect. So we are comfortable, and that is what market is also indicating. Stock financial market is a very nice indicator. It is indicating that it is. Yes? Yes. Yes. Start होते ही. So this is what it is indicative. So inventory management, one more aspect is there. Please. Very important aspect is, now in multinational exercise, how we are going to use it, but most important is don't forget just in time also. Your storage cost versus sourcing cost or logistic cost, both way has to be evaluated, and ultimately you have to decide where to keep inventory, how much inventory you should keep. Obsolescence is there, and uh, you know, technology is another factor to decide about inventory. Don't keep that inventory which is prone to technological obsolescence. If tomorrow technology changes and you don't require it, it's wastage. So these are the certain factors. Identify those factors and accordingly decide. So your location, procurement, quantum, all these factors ultimately in a being multinationals you have to decide. Multinational has got one last part also related to taxation in taxation policy of that country, and taxation policy decides these things. And one more factor, not to all businesses but to some businesses it is there, is called natural environment factor. Quantum of moisture is there or heating is there, cooling is there, that also decides where you should keep how much inventory. Is it clear? So don't keep there where it is an adverse environment is taking place. You will be in a deep loss, deep trouble. So better to look all these dimensions, these variables, and decide how multinational is going to make it. Okay, so this is all about working capital management of it. Ultimately, operating cycle has to get created, and multinational doesn't have any problem of operating cycle because they are working in different economic cycle. Think of a typical multinational who is located in all continents. Maybe an American headquarter, working in South America, Africa, Australia, Asia, Europe, everywhere is working, every location working. Something like never sunsets in that company's arena. Then it happens, you will find out they are well placed, well versed, and they are well managed because they are really very global taxation and every aspect is taken care of. Okay, so true kinds of diversification they make it, and multinational can easily manage these things. One more aspect which I want to highlight, and then I'll wind up the case. That is, it was more related to political risk, and just a minute, give me 1 minute, I'll take slides also to show you. This is actually not from producer's point of view, rather it is from investor's point of view, how this management is going to take place. I'll show you this. International Monetary Investment Fund investment is there. How international portfolio and what is the benefit of international portfolio is there, that I am considering. See, some of the terms I'll first float to you, and then after I'll request you to jot down those terms. There is a equity, there is a bond market or debt market, and there is a portfolio, the combined concept. When we say equity, when one organization go abroad and raise fund, equity's nomenclature changes. The name of equity changes. For example, when you go and raise, an Indian company goes and raise equity in USA, it is called ADR, American Depository Receipts. Okay. And if so many countries you go and raise your fund, it is called GDR, Global Depository Receipts. Clear? So ADR and GDR, maybe short notes or process could be asked to you in the examination and the theory portion. Okay, ADR, GDR. This is when you have to have the equity market. When you have debt market, as a bond market, there is a global bond market. Outside bond market is also there. Let's say someone is now issuing bond abroad, that country, now question arises too, you are raising the equity bond there, are you raising in the currency of that country or you are raising the currency other than currency of that country? Say in USA, if you go and raise bond in US dollar, is it clear? In USA, you are raising the bond, that raising the bond in US market in US dollar, then that bond, but raiser, the person who is raising the bond, the raising the fund belongs, is a non-US, say belongs to India. So Indian company went to USA, raised the bond, issues the bond to that, bond denominated in US dollar. It is called foreign bond. For whom? For American. It is a foreign bond because party who is issuing belongs to other than USA. That is called foreign bond. Foreign bond has got different name. Okay? Like in USA, the bond which is issued by foreigners are called Yankee bond. Y-A-N-K-E-E, Yankee bond. Actually, it is it is the nomenclature which somehow some tribe, some sect, some ethnic group terminology has been given, which gives a kind of notation not belonging to that country. Okay. If you raise that bond in UK, in say Great Britain pound, it may be called as bulldog. It's a foreign bond, bulldog. In Japan, it could be called as samurai, samurai bond. Okay, like that. Okay, somewhere maybe matador in the Dutch one. Like foreign bonds has got different different nomenclature, different naming, and all naming by try to decipher that, and it actually came to be a kind of a representation of a tribe, a representation of a group of people coming from outside, that kind of things. So if you went to UK and raised the bond in GBP, it was foreign bond. But suppose in UK, Britain, you are raising the bond, you are an Indian, but raising the bond in USD, US dollar. Understand, USD is the currency of USA, and in that currency you are raising where? UK. That kind of bond is called Euro bond. What is called as? Euro bond. Euro bond means not raised in Europe. It started in somewhere post Great Depression of 1929, in late 1930s. What had happened when in currency market, currency start getting stored outside also. And in currency market, London was the center, global hub of the currency market. I am talking 1930s. During the before, during and after Second World War. Okay? Mid 30s, 30s, 40s, 50s, 60s, like that, during that period. So now what is happening? In London also, most of the banks has got a good quantum of storage of US dollar. So US dollar was available in USA. US dollar was available in UK. Suppose I am an Indian who had to raise the fund in US dollar. Now I have a two destination to raise the fund of US dollar. So US dollar in USA was at a particular interest rate. US dollar in UK at a particular interest rate. Now I can't call it US dollar, or the nomenclature can't be dollar only. So what the nickname appeared, and that nickname was euro dollar. Means dollar available in European market, euro word. Understand, the present day euro currency was not available at that point of time. Is it clear? I am talking long back 1930s. It was, euro had appeared in 99, came into parallel existence, and after 2000 it became currency of European Union. Clear? So euro dollar means dollar in European market. Later on, after Second World War, after 1940s, even Asia also started making it Asian, dollar. Asian dollar means dollar in Asia. But euro dollar was the name, Asian dollar name didn't got hold to that extent. And then this became a generic name. What is generic name? Euro dollar. If dollar is in USA, it is US dollar. If dollar is out of USA, in any country, it is euro dollar. So even if suppose dollar is there in India, available for lending and borrowing, it is called as euro dollar. And not only that, euro dollar became the generic word, then euro also became generic word, and during that period itself, any currency out of its own country land will be considered as euro currency. Is it clear? This is the way people started making it. So euro currency means if Indian rupee is going to be out of India, it is euro INR. Clear? That's the concept had been used. So similarly, euro bond appeared. And what is euro bond? If a bond is in the currency other than the currency of that country, that is called euro bond. Am I right? So now question is, equity is ADR, GDR. There another side it is euro bond, foreign bonds, and then it might be possible in India also somebody else will come and raise the fund not in INR, somewhere in some other currency in India. That is also could be there. In 2002, there was a deposit scheme called IMD, India Millennial Deposit, which was actually not in Indian rupee, rather in foreign currency. One can deposit it. Clear? There is another concept which is actually coming, and masala bond. It is basically a term given by UNA because India is known for a spice land. No, you just search for masala bond. Okay. And what is the definition of masala bond? Search for it and let me know the definition of masala bond. You have Google, you can do that. What way it is going to be considered, how it is raised outside is very important. What is the term? What is the explanation, masala bond? Read out.
Masala bonds are bonds issued outside India but denominated in Indian rupees rather than the local currency.
Some America, we go to USA and issue it in INR. Okay, someone is holding there, INR, investing in that. This term, and how to identify it is Indian? Masala. We are known for that. So that's the way it is viewed. So anyway, I'll take you to the journey of ADR, GDR and Euro bonds. Not too much on masala bonds, but most important is the portfolio, how international portfolio is going to be held. Okay, in next class. Thanks for it. Any question you have, you can ask, or otherwise we can wind up. Thank you. Thanks a lot.